Staying very close to the chip sector, our favorite fruit stock, Apple, ended lower on Monday after IDC said its personal computer shipments cratered by 40.5% to 41 million in the first quarter, while global shipments fell 29% overall. Mark, is it time to load up on big tech crash protection after this bad news?
I mean, we've seen all the headlines, right? 7 stocks accounted for what, 90. Shaw can pull this out, just knows this. He wakes up in the morning, knows these numbers, but something like 90% of the rally from 3,900 to 4,100 was just like 7 stocks. And Apple being the leader of these, I think it's a little overstretched, and by that I mean I think it's a lot overstretched. And it's been a hedge fund hotel. Money is piled in there as a safe haven. At some point, they're going to bail. And now, does that mean Apple's going to zero? No, Apple's fine, but that doesn't mean it can't take a 10 or 15% haircut in a very short period of time. And I think some of these big techs are kind of set up for that with the way they've rallied in the face of a potentially weakening economy, rates still really high. Mostly because there's not been a lot of alternatives, right? You can't put, normally with rates going up, you like the banks, but you look at what's going on with the banks, and no, I wouldn't touch it with Shaw's 10-foot pole. So that's why we've seen the money, I think, flow into these techs. But at some point, they're going to hit the exit, and that's what you really have to worry about.
That's the real question. That's the real question. At the hedge fund hotel, you could check out any time, but can you leave? We'll leave that up. I'm not sure.
Terrible.
Come on. How else am I supposed to relate? I try to relate to my companions here. All right, fine. I'll stick to Cardi B.
Thank
CJ?
you.
Thank you.
CJ, what's your take on Apple? You got to have some levels in this one.
I mean, again, you look at this, and a month ago, we had analysts coming out saying this is a safety trade. People listen. I mean, it's a lemming trade. That's what it is. It's a lemming trade. 162 right now. It is one of the very few technology stocks that's trading in a technical bull market above its 20-month moving average. I think that's the line you watch. And as I look at the chart to my left, that's about a 155. So if you break down below 155, I think you start to get some of those short-term traders that Mark was just talking about, maybe sidestepping some volatility. At that, you trade it maybe down to a 140 mark. I remember Mark and I were actually right about this hitting 125. I don't think it sees 125 again. I think that, this is the stronger higher high, higher low pattern that I see right now out there.
Yeah, but at the same time, the question is, when do you want to buy this thing? I mean, if we're going to surpass this 150 level and get below the point of control, I see the value area low would be 137. So would you start snapping this up or trade it in its... Okay.
Yeah. Well, what's important to remember here, and we talk about sentiment a couple different ways here on the show. This is truly, 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 truly an overloved stock. Overloved stocks are dangerous when you're in a bear market. This Vaz, as you see, every buyer of Apple over the last 3-4 months here has turned into a potential seller because there's still that cloud over this market of a bear market. So what Mark was describing a little earlier is a term that we were using last year with regards to Apple, Microsoft, Google, Tesla to some degree. And that is that they have redemption risk. They're held by every ETF out there. But more importantly, now they've been singled out as a safety trade with their 0.5% dividend yield. But it is extremely, 10 pounds of flour in a 5-pound bag overcrowded right now. So watch that because the crowd could go back.
How about this one? I'm looking at these mega caps, and you want to stay in the mega caps, but you want to maybe take some money off the table on Apple. Take a look at Google. It is, from a value perspective, less expensive than Apple. They're more in the forefront of AI than Apple is. Apple, when was the last time they actually did something innovative? They are a utility. But if you want to stay in the tech space, you want to participate in that big upward rally, the lowest PE out of any of these names, the one that I think probably has the most potential to participate in the AI meme, but also has some good results. So it would be a Google. That would be my thought process. I don't know. You think I'm wrong? Feel free to disagree with me.
I think you're spot on, Mark. And what's also interesting, you said you think Apple could see a 15% haircut, and that's right in line. They takes you to the 137 level that Voss was talking about. It is an overcrowded trade, and as far as the hedge funds, they're starting to sell some of the tech names that they bid up. It wasn't just a safety trade for the hedge funds. It was a momentum trade. Let's get everybody in and start buying this stuff and keep buying it. And then retail came in, everyone came in. And now they're starting to take profits. So I think that 137 level is going to be really interesting. I don't know that I'd be a buyer there. I'd be worried there as to what the next step would be for Apple. But also agree with you, Mark, on the Google. Much better play. Longer term, I prefer Google.